I'm moving to publicly traded real estate. Uh, it's about equity in a publicly traded real estate that matters. So we have REIT and REOCs, real estate operating companies. The are tax advantages company, whereas REOC are not tax advantages companies. Residential commercial mortgage-backed securities. So advantage are superior liquidity, low minimum investment, limited liability, access to premium, access to professional management. REIT specific advantage are exempt from taxation, predictable earning, high yield. Disadvantages are tax versus direct ownership, lack of control, cost of legal corporate restriction, price determined by stock market, structural conflict of interest. REC in structures upbeat and downbeat, there are potential conflict of interest when opportunity arises to sell property or take borrowing. A particular action may have different tax implication for REIT shareholder, limited potential for income, lack of flexibility. Economic value determination. So national GDP is the largest GDP is the four REITs. So different types of REITs are shopping, office, residential, healthcare, retail, hotel, and each has different. So retail sales growth is highest factor for shopping retail, job creation for office, job creation for residential, population growth for healthcare, industrial has retail growth, hotel has job creation, and storage has population growth. So these are the form of metrics that they have created in here. Now, principal risks of RIT are based on these things. Other risks are occupancy rate and things like that. So, due diligence consideration, remaining lease term, inflation protection, in place rent versus market rent, cost to release rent, tenant concentration in the portfolio, tenants, financial health, new competitors, balance sheet, and quality management. Subtype of equity: retail or shopping or central lead, office REITs, residential REIT, healthcare REIT, industrial REIT, hotel REIT, storage REIT, diversified REIT. Estimate NAVPS based on forecasted net operating income. So NAVPS is net asset value per share, capitalization, net operating income, property value. Property value is net operating capitalization rate. Let's look at a question here. So we are valuing a shopping center REIT. They've given to us last 12-month NOI, cash and equivalent, account receivable, total debt, other liabilities, non-cash charges, full year consideration, acquisition, land held for future acquisition, prepaid expense, estimated next month, discount. So the last 12-month NOI minus non-cash rent plus full adjustment for acquisition is equal to pro forma NOI for the last 12 months. If you grow that, then you get pro forma NOI for the next and capitalization rate to get the estimated value. Once you have the estimated value, then use the cash equivalent, land held for future development, account receivable, prepaid and other assets to get the estimated growth value. After that, subtract total debt, other liabilities to get net asset value and divide by share outstanding. So straightforward process. Funds from operation is accounting net earning plus depreciation plus deferred tax minus gain and sale of property plus loss from sales is equal to fund from operation. So FFO is an operating important term here, and there are many numericals based on that. So plus depreciation expense plus deferred tax expense minus gain or sale gains from sale of property or debt restructuring plus losses of sale of property. So you do that to get the fund from operation. Adjusted fund from operation is non-cash rent adjustment and recurring maintenance time capex. So the capex thing differentiate both of them. Net asset value per share expected from FFO or FFO discounted cash flow approach. The last numerical here before we close is calculate the value of IT based on net asset value, price to FFO, price to adjusted FFO, discounted cash flow method. There are given three methods to calculate the thing. The price to FFO, price to AFFO, and discounted cash flow. So approach 1, net asset value, approach 2, price to FFO, approach 3, price to AFFO, and approach 4, discounted cash flow. Now we'll start with what is the given to us. So we are given net operating income, last year FFO, cash equivalent, account receivable, debt, non-cash recurring, shares outstanding, expected dividend, annual dividend, dividend growth rate from 2007 to perpetuity, assume cap rate, and so on. So we are given information on that as well. So this big question then moves to approach 1, valuing REIT from a net asset value approach, which starts with estimate NOI, assume capitalization rate, then you'll get the big money chunk, add cash, net asset value, share outstanding. and when you move ahead, uh, you have values of REIT share, price to FFO approach, funds from operation, shares outstanding, FFO per share. So that is price to FFO approach. So funds from operation you have, shares outstanding you have, FFO share were applying subsector average, you multiply that into 10. So this price to FFO is like a relative approach. Then value of REIT using price to AFFO. So price to FFO and price to FFO you need to find out the multiple. Funds from FFO, non-cash rents, subtract recurring maintenance time capital expenditure equals AFFO, shares outstanding AFFO per share. So FFO you subtract non-cash rents and subtract maintenance capex to get AFFO, and then use AFFO. We have been looking on the difference between FFO and AFFO. The dividend per share, you take the total value of dividends and the final value, terminal value, to get to the answer. So those are the three ways. Just a quick revision. Price to FFO says that FFO divided by share and value, FFO by share into sector average should give us the value. Price to FFO said for FFO minus non-cash minus recurring expenses. How to calculate the FFO? So accounting net earnings plus depreciation plus deferred taxes minus gains is funds from operation. FFO from operation minus non-cash and recurring maintenance FFO. So those are how you are going to. So that ends this chapter.